Our session is on finance and the financial manager. We cover several topics that serve to introduce the material in the course. These topics provide context and structure for what follows. First, we consider several organizational structures that the firm can take. Next, we move to the role of the financial manager as actor between the firm and the financial markets. We define some common finance terms that we'll be using throughout the course. Then we describe the financial analyses and decisions that we're going to be covering in the course. There are three types of organizational structures that firms can take. Sole proprietorships and partnerships entail unlimited liability for their owners, and the owners pay personal taxes on the profits of the firm. Corporations provide for limited liability for the owners. The corporation itself pays taxes on its profits, and if the corporation pays dividends to the shareholders or owners, the shareholders will pay taxes on those dividends. In addition, if the owners sell their stock at a profit, they'll pay capital gains tax on those profits. Corporations can be characterized by principal-agent problems in the case where the interests of the owners diverge from those of the managers. The financial principles covered in the course apply to all of these organizational structures, and indeed to families and individuals as well. While we'll focus our attention on corporations as the dominant organizational form in our economy, occasionally we'll apply these financial principles in the course to the interest and decision making of individuals. The financial manager can be conceived as working between the firm and its operations and the financial markets. One assignment for the financial manager is to raise cash from the financial markets, that is from either equity or debt investors. Equity investors are shareholders or owners, debt investors are lenders. Once the firm or the financial manager has raised those funds, then the financial manager is charged with advising the firm as to how to invest the cash so as to increase the value of the firm to its owners. If the firm generates cash from operations, then the financial manager has the assignment of deciding how to use that cash. And the choices amount to reinvesting the cash in the operations of the firm so as to increase the value of the firm to its owners, or paying the cash out to the investors, either in the form of dividend payments to the shareholder owners or interest payments and return of principal to the debt suppliers. An expanded concept or consideration of the role of the financial manager beyond the scope of this course would be to think of the financial manager as having first the assignment of preparing the financial statements of the firm. You can think of the financial statements of the organization as depicting the results of the decisions that we're going to be covering in this course. A second assignment for the financial manager is to help in developing the strategic financial plan of the organization, which is developed to support the overall strategy of the firm. You can think of the strategic financial plan as a set of projected financial statements into the future, whereas the historical financial statements describe what has happened historically. The strategic financial plan is a pro forma or projected set of financial statements. We'll cover strategic financial planning toward the end of this course. A third assignment for the financial manager is to analyze capital expenditure proposals that might come from senior management or from some other place in the organization. A fourth assignment is to determine the optimal capital structure of the firm. By this is meant, what is the right mix of debt and equity to support the capital expenditure of the firm and to support the firm's operations so as to minimize the overall cost of financing. A fifth assignment is actually to go and secure the capital financing that the firm needs, whether it be securing debt by selling bonds to the public or securing equity by selling stock to the public or to other ownership types. In this course, we'll focus our attention on these last three assignments for the financial manager. That is, we're going to focus our attention on the analysis of capital expenditure proposals, on the determination of optimal capital structure, and on the securing of capital financing. But there are some other assignments that the financial manager has that we won't be covering in this course. One is management of cash. Cash management actually has several aspects, and I've listed a couple of them here for your consideration. One is working to ensure that the firm collects its receivables from its customers as rapidly as possible so as to minimize the cost of money tied up in accounts receivable. A second is to invest the cash that the firm has on its balance sheet in a portfolio of investments that maximizes return. And then the last kind of general assignment for the financial manager is a big one, and that is to achieve the financial plan. Controlling involves cost management systems such as budgeting systems, and it involves revenue maximization aspects such as price setting and indeed even marketing. Now some common finance terminology. We want to distinguish real assets from financial assets. Real assets are physical things like equipment, buildings, sometimes inventories. Often they show up on the balance sheet of the organization as plant, property, and equipment. They represent the physical capital that the firm combines with labor to produce goods and services that the firm sells. In contrast, financial assets sometimes show up as other assets on the balance sheet, and they typically represent cash and the investment portfolio of the firm. In this course, we'll use the terms capital markets and financial markets pretty much interchangeably to represent where the firm goes to raise financing. We'll also use the terms investment and capital budgeting or capital expenditure analysis pretty much interchangeably to describe the decision analysis that the firm undertakes to evaluate new programs, new businesses, the acquisition of new assets. And finally, financing is a term we'll use to describe the acquisition of funds by the firm to support its investments and operations. This course will cover some specific financial analyses and decisions. These analyses and decisions are designed to help solve two basic finance problems. The first one is the investment decision problem, which can be phrased as how much should we invest and what assets should we invest in. Some examples might be, should we purchase a new piece of production equipment, a new piece of manufacturing equipment? Should we invest in a new office building? Or thinking really big, should we purchase another firm as a new subsidiary? In terms of personal investment decisions, you might think of whether you should purchase a new house, or whether you should purchase a car, or maybe even whether you should purchase a fancy sailboat. The financing decision is often characterized as how should the cash required for the operation of the firm be raised? There are essentially two general sources of financing: debt financing or borrowed funds, and equity financing, which is often raised by selling stock or retaining earnings. Both of these decisions are made with respect to one criterion, and that criterion is to maximize the wealth of the owners, or to make the owners of the firm as well off as possible. That is, to maximize the value of the firm to its owners. In the corporate world, the value of the firm is represented by cash flow that might be used to support either an increase in the price of the stock of the firm or an increase in the dividends that are paid out to owners. These finance problems have important characteristics that determine how we approach the solution to these problems. First, in approaching these problems, we focus on cash flows instead of accruals. Now we're getting into some technical finance terms. To distinguish cash flows from accruals, let's first think about the difference between expenses and cash outflows. Okay, an example might be the firm purchases a capital asset, like a new piece of manufacturing equipment. That purchase is not reflected as an expense at the time of purchase. Rather, there's a significant cash outflow that will show up on the cash flow analysis that we're going to be doing, but no expenses recorded right as the asset is purchased. Over the life of the asset, the costs of that asset are spread out and recognized as depreciation expense. And as depreciation expense is recognized, it is in fact recorded as an expense on the income statement of the organization. But it is not a cash outflow to the firm during the period of the depreciation expense recognition. We're going to be focusing in our capital expenditure analysis in particular on cash outflows, not expenses. Let's also distinguish revenues and cash inflows. A good example is when the firm borrows funds from lenders. When it does so, there's no recognition of revenues into the firm. Rather, there is a significant cash inflow as the firm sells bonds to the public or borrows in another way. Let's say takes out a mortgage at a bank, but there's no revenue. In the financing part of the course, we are going to be focusing on the cash inflow associated with borrowing funds and not recognizing that as a revenue. So that's the first important characteristic of these decisions, is that we focus on cash flows instead of accruals. Hence, this is very different from what's looked at in a cost accounting course where you're focusing on revenues and expenses. Here we focus on cash inflows and cash outflows. Some other important characteristics of these decisions that we're going to need to keep in mind as we move through the course. The decisions typically involve consequences for the firm that last for several years. Now, several years could be anywhere between 3 and 100. So the decisions we're looking at are decisions that involve or have implications for the cash flows of the firm for some period of time between 3 and, let's say, 100 years. When we do these decision analyses, there's typically significant risk in projecting what the future cash flows might be. That is to say, when we set up a new business, we certainly don't know with any degree of certainty what the future cash flows are going to be associated with that new business. We have a projection about what our revenues, or I should say our cash inflows are going to be. We have a projection about what our expenses, that is, I should say our cash outflows are going to be. And we do our best to handle the risk of future cash flows with some important risk handling or risk management techniques that we'll discuss later in the course. Finally, some organizations in their decisions, in their financial decisions, care about other than cash values. I want to start by noting that what we're going to do in this course is just to focus on the cash implications of capital expenditure or investment decisions and capital financing decisions, and not to deal with the non-cash values. I do want to note that there are some firms that take account of social values in their investment decision making, but that won't be part of this course.